Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. Today we're talking about a household name, PepsiCo. This is a dividend aristocrat and king with a dividend growth streak dating back to 1971. That's made Pepsi a really popular holding in many retirement portfolios over the decades, but it feels like something started to change in the last year or two. Pepsi's stock price has been falling like a rock, especially compared to the market and even its rival Coke. We've seen sales volume start to decline. Pricing power feels like it's kind of hit a wall, and consumer eating habits and health preferences have really been evolving faster as well. So in today's video, we're going to be talking about why exactly Pepsi has been stumbling, how the company is trying to adapt, and really whether or not long-term investors can continue to rely on Pepsi as being the dividend growth machine it has been known to be for many years. Most of Pepsi's challenges are inside of its North American foods business, which accounted for 42% of operating profit last year. That's actually more than double Pepsi's North American beverages business and shows you the importance of snacks to Pepsi's overall profits and growth outlook. Now, I've owned shares of Pepsi for a decade, and unlike Coke, I liked that Pepsi had this sizable portfolio of snack brands, mostly anchored in chips, everything from Lay's to Tostitos. There's also a few more health-focused brands like Popcorners, which are a type of popcorn-based chip. But owning both snacks and beverages gives Pepsi some advantage when it comes to pricing power with its retail customers like grocery stores, because these are both high-traffic staples that consumers tend to put in the same shopping basket. So this makes grocery stores a little bit more reluctant to push back on Pepsi on price on the chip side because they don't want to lose traffic from, say, Gatorade. So Pepsi can also cross-promote these products together. That kind of ensures it has nice shelf space and kind of the end caps of aisles to promote these types of products. Delivering both chips and beverages to the same store at once also has some cost efficiencies. So there's a lot of unique synergies, I think, to owning both types of portfolios. Now, the snack side of the business was also viewed favorably in the past because unlike sales of soda, which were seeing secular volume declines, snacks were growing. This chart here is showing you the organic sales growth rate of Pepsi's North American snack business going back to 2019. The year before the pandemic, this business was growing about 5% per year with both prices and volumes going higher. And then, of course, once the pandemic hit and people were stuck at home, a lot of these at-home food companies like Pepsi did very well. You can see its snack sales jumped from 15 to 20% year over year type of growth figures. Most of that was pricing, higher prices. But that trend has quickly decelerated and now flipped negative. The last 3 quarters, this part of the company has seen its sales decline at a low single-digit type pace. Looking at just the volumes behind Pepsi's North American snack segment, you can see that, again, in the past, this was a pretty steady, flat to up maybe 2-3% type of volume business, but the last 6 quarters we've seen volume declining anywhere from 2% to 4%. And there's a lot of questions about why this is happening. The most hopeful reason is that consumers are just tightening their belts. They're tired of those big price hikes from past years, and they no longer quite see the value that used to be behind some of these brands. They're choosing instead cheaper private label options. Here in central Indiana where I live, one of the main grocery chains is Kroger, and a bag of Tostitos chips, I just checked, is $6 for 12 ounces. That's about $8 a pound. You're starting to approach ribeye territory for what is essentially a glorified circle of corn and salt. So I think consumers are really seeing this. They're really questioning the value of a lot of these brands right now, given the price hikes we've seen. And Pepsi's not alone. I mean, there's other big companies like Smucker, General Mills that are seeing similar volume declines, which is a little bit comforting, honestly, for Pepsi that it's not just something wrong with its own portfolio. This is kind of an industry-wide phenomenon, which has caused some investors to also wonder, well, maybe it's not just belt tightening. Maybe it's actually reflecting some lasting changes in how people eat. We've seen RFK Jr., the health secretary, be pretty critical of processed foods, artificial dyes, pushing back on some of the really core areas that make up part of Pepsi's portfolio. Pepsi has said that over 60% of its U.S. foods don't have any artificial colors, and big brands like Lay's and Tostitos will also get there by the end of this year. So it's working to adapt, But there could be some concerns about Pepsi needing to kind of reformulate parts of its portfolio to be more aligned with some of these healthier eating trends. I think the biggest unknown, though, that's really weighing on sentiment in this space are these weight loss drugs, the GLP-1s, like Ozempic. These were approved by the FDA a few years ago now, and they're super popular. I think I read close to 10% of Americans are using these medicines right now for weight loss, and the main effect, it suppresses your appetite. There was a study here by some professors at Cornell that looked at over 2,000 of these GLP-1 users and tracked the change in their household's grocery bill 6 months after they started taking these drugs. And they found that the average grocery spending dipped about 5 to 6% over that time. And not a big surprise here, but a lot of that reduction in spending came from categories that are high in calories, not very nutrient dense. Chips and other savory snacks was the biggest losing category, seeing spending fall 11% during this study. You can also find soft drinks here, one of the top 10 categories. It also fell about 6 to 7%. So a lot of what Pepsi does is kind of in the crosshairs if you believe that, you look at the American population, right? Over 70% of Americans are either obese or overweight. So they could be good candidates for these GLP-1 drugs as the drugs become more mainstream. Maybe they become more cost effective. There's work on an oral pill instead of having to take an injection to get the treatment. So what happens if 20, 30, 40% of US adults are on these medications and potentially eating less? That's a big unknown for investors, and I think that is why a lot of these food companies, including Pepsi, are seeing a pretty big reduction in their valuation multiples today. So let's take a closer look at Pepsi's financials and talk more about what the company is doing to be able to adapt to some of these threats in the years ahead. I'm using our website, Simply Safe Dividends, to take a closer look at Pepsi's dividend safety and fundamentals. Pulling up the stock here, we can see that Pepsi offers a dividend yield of 4.35%. We give the company a very safe dividend safety score of 93. If you're unfamiliar with our scores, they range from 0 to 100. Pepsi lands in our strongest bucket here of very safe ratings. We're the only company I'm aware of that maintains a real-time track record showing the nearly 900 dividend cuts we've seen since we started doing this in 2015. Every cut is posted here in our timeline with the score we had on the stock right before the cut was announced, so you can see the predictive value that those ratings provided. Bottom line is, investors who stuck with companies that scored above 60, so in our safe and very safe buckets, they would have avoided at least 97% of the dividend cuts that occurred over that last decade. So right now, we think Pepsi's dividend looks safe. I'll talk more about that in a minute. You can see the company also earns an A+ credit rating from S&P, so a strong investment grade rating. And Pepsi's stock has historically been less volatile than the S&P 500 with a beta of 0.47. That basically means Pepsi's share price over the last 5 years has been about half as volatile as the S&P 500. Now, here's the problem. Pepsi's share price has been falling much faster than maybe it ever has before. The last 18 months or so, we've seen Pepsi just in this steady downtrend. The chart you're looking at here is plotting Pepsi's share price, that gray line, against the price you would expect Pepsi to trade at, that blue band, if the stock was 10% above or below its 5-year average P/E ratio. A lot of these mature blue chip stocks trade at persistent valuation multiples over time. You can see how closely Pepsi has tracked its earnings there with the P/E ratio. But there's been a big break in that relationship the last 18 months. And that's the million-dollar question. So if we come down here to the valuation charts, you can see why Pepsi has fallen so far below that expected price band. So the stock, the last 5 years, has traded at an average forward P/E ratio of 24 times earnings. But right now it's at just 16 times earnings. So the market has really been discounting a weaker growth outlook for Pepsi. Usually when you see these situations where the stock price is breaking a lot lower, they tend to coincide with earnings doing the same thing. But Pepsi's earnings per share got a nice bump during the pandemic, and they're not growing, but they're not really shrinking this next year. Analysts are kind of baking in basically flat to slightly down earnings growth. And they actually expect earnings to start growing at around 6% per year beginning in 2026. So this is kind of viewed as a transition year at least by the sell side. Usually these companies that are falling in price can typically have a weaker financial state as well. But Pepsi's balance sheet is really strong. We talked about the A+ credit rating earlier. This chart here is showing Pepsi's leverage ratio by measuring its net debt, so debt net of cash it holds, against the company's EBITDA, or earnings before interest, taxes, depreciation, amortization, kind of a rough proxy for cash flow. And we can see that multiple has stayed very steady and low at around 2 times. So to me, that's pretty conservative, even after accounting for Pepsi's recently announced deal to buy Poppi, a soda brand. That's not going to do much to the balance sheet. So Pepsi has a lot of flexibility there. If it needs to go out and make an acquisition to keep its portfolio relevant on the snack or beverage side, it can certainly do so, especially in the slower growth environment. I think we'll see more M&A. So Pepsi's financial health looks great. It's just the growth has slowed down quite a bit, and people are worried about the future. Now the payout ratio has ticked up a little bit with earnings, not growing much at all this year, maybe even dipping a tad, while Pepsi's dividend has increased. So the payout ratio could sit just north of 70% in the year ahead. That's not crazy high for a consumer staple business. It's edging higher than I prefer, but it's by no means a dangerous level. I think the only thing that could really jeopardize Pepsi's dividend is if it ends up waving the white flag on part of its snack portfolio and says, hey, we have a lot of brands here that aren't on trend. We need to just divest them or spin them off. And when we lose that cash flow, the payout ratio is going to jump higher than we want it to. I think that situation is pretty unlikely right now, at least, but that's really the only factor in my mind that could kind of jeopardize Pepsi's dividend. But the higher payout ratio and the weaker near-term earnings growth kind of explains why Pepsi's dividend growth has decelerated a little bit. So the 5% raise that was announced in February does mark a step down from kind of that 7 to 8% per year growth we saw over the last 5 to 10 years. I'm guessing Pepsi's dividend hikes will continue, but probably at an even more subdued rate. I could see a sub 5% raise being in the realm of possibilities next year if we haven't seen some improvement on the snack side with its growth. But Pepsi has still paid a safe dividend for 60 years. The dividend has increased every year for 53 years if you count the February raise we saw a few months ago. It's just growth is a lot slower, and that is the big question that investors have to make a bet on right now is, do you think Pepsi will see its growth return and kind of justify a higher multiple, or is this the new normal? Now, Pepsi has published a few slides kind of showing its growth runway here. One of the biggest arguments in favor of long-term growth is Pepsi's international footprint. So 40% of sales right now are coming outside of North America. You can think of big markets like India and Brazil where they have growing populations. The middle class is getting wealthier. They can afford to have more of these indulgences and just frankly consume a lot more of the products that Pepsi sells. In fact, 95% of the population comes from those markets outside of North America that represent just 40% of Pepsi's sales. And they've been growing at a nice double-digit clip the last 5 years. So that's kind of a long tail. Weight loss drugs are less of a concern given their price and distribution problems in a lot of these international developing spaces. So I think that is a definite positive for Pepsi, but North America remains a pretty big anchor right now at 60% of sales. Pepsi also highlights its efforts, which have been ongoing for years. I mean, the company has had sell-offs in the past with concerns about, soda volumes being weak. Consumers are consuming less sugar. So Pepsi's always been working to take out sodium, saturated fat, sugar where it can. But at the end of the day, this is still a portfolio that doesn't really have protein-rich foods it can easily pivot into. That's really kind of what's needed for these weight loss drugs for consumers that are on them. They're seeking protein, and Pepsi's portfolio doesn't really have that, even if it can kind of make some of its indulgences a bit healthier, relatively speaking. You can see Pepsi kind of highlighting that here again, trying to meet evolving consumer preferences here. Nutrient dense, it labels it, but these are still bags of chips. So, to the degree that consumers shift away from some of these products, Pepsi will definitely feel a bit of a pinch there. But there are some things the company is doing that I think will continue to keep it resilient. These low or zero sugar soda has been a nice win in recent years. The Bubbly brand is now $1 billion brand. That's been a success as well on the carbonated water side. Pepsi will also highlight some of its hydration offerings here between Gatorade Zero and Propel. There's some opportunities with fiber with the Quaker brand. They also have the Muscle Milk brand, some energy drinks. So it's just a very, very diverse portfolio. And with Pepsi's balance sheet strength, they can kind of keep tacking on brands and then putting them into their big distribution system to get some synergies there as they need to. Here's some highlights of the international side of the portfolio, how they kind of adapt the brands to different markets. This is what Pepsi's an expert at, right? I mean, they've been having to do this for decades. It's not the first time they may have to adapt. And right now it's a lot of fear driven in the stock as well. You have the mini cans. One argument too, I think, when you think about the GLP-1s, that makes some sense to me. These could be used almost as like a gym membership. A lot of data shows that people don't want to stay on a drug their entire life, and they don't stay on these weight loss drugs forever either. They come off after 3 months, 12 months. So perhaps there's a world where when someone drifts far enough from their target weight, they get back on these medications, and that kind of keeps these ingrained brands and habits as part of their lifestyle, and they're kind of using these weight loss drugs selectively to manage the physique that they want, the health that they want, but not kind of every day for the rest of their lives. Hard to say, but if that is the case and people do eat a little bit less, Pepsi can offer these kind of mini-sized packages. Here's an example with the Lay's chips. It's always so frustrating when you open a bag of potato chips and it's not even halfway filled. But Pepsi's an expert at that. So you might have people eating a little bit less, but they might be the most profitable customers Pepsi has ever had if it's able to give them these kind of right-sized indulgences that they still desire, but they're paying a lot more per ounce for those experiences. Like a 100-calorie bag of Doritos is a good example of that. So I don't think Pepsi should be ruled out at this stage. I plan to keep holding my shares. I'm not going to nibble further quite yet. I'd rather see Pepsi show some progress with returning its snack business to volume growth again. I think if that begins to happen, I mean, Pepsi has a long ways it could go to kind of re-rate if investors start to say, hey, it's kind of gone too far here. Pepsi is still a very resilient business. It can still grow. Maybe not quite as much as we thought 5 years ago, but some of this fear has been overblown. I think that would be kind of the best case scenario for Pepsi right now. Otherwise, the company remains financially healthy. I still think it could do well if we do see a recession. This is the type of stock that just delivers reliable cash no matter whether times are good or bad. So I still feel okay about Pepsi. I'm going to hold on to my shares as part of a diversified portfolio. And I hope this analysis helped you get some clarity if you own Pepsi or have been looking at it as well. I'll show you a few more things here on Simply Safe Dividends in case you're unfamiliar with our website. Here's the portfolio tracker I mentioned earlier. You can either import or sync your holdings. You'll have access to this holdings table, which is super flexible. You can pick from a few dozen column options. You can move them around to get that exact view you want to stay on top of the information that matters most for your portfolio's holdings. You can see the valuation indicators right here, dividend yield charts, dividend safety scores. If we ever publish research, by the way, on a company's dividend safety score, upgrading it, downgrading it, reaffirming it, we'll send you an email right in your inbox so you're never surprised by anything. You can see your portfolio's overall dividend safety. This one I put together is pretty solid. Here's one that has more of a mix of ratings with the income stream, just to make sure it aligns with your risk preferences. Diversification is one click away to make sure your bets are spread out across different sectors and income sources as well. So it's just a really powerful tool if you're into dividends to make sure you're on track. Keep your portfolio between the guardrails is something that I like to say a lot. We also offer a quarterly newsletter with 3 model portfolios that you can follow along with that execute this strategy. There's a powerful stock screener and closed-end fund screener you can use to find ideas that meet what you're looking for. So it's a lot of fun to play around with, and it's completely free to try. There's a 2-week trial, no obligation, but there's no credit card required or anything like that if you want to check it out. I'll leave a link in the description below. Thank you for watching this video, and I hope to catch you next time.